the Fed staying the course, no surprises there. But was it, as I said in the headlines there, less about what the Fed did because the market was pricing that in, but more about what it had to say about the future of those rates moving forward and also things like unemployment? And, what would you make of the markets coming to grips with some of those comments today, given the performance we're seeing out there?
Well, I think, first of all, the market is finally believing the Fed and Jay Powell that, in fact, they are going to raise rates until they see inflation coming down. I think in July, the Chairman Powell was a little bit equivocal, and therefore the market said, well, he may pivot soon. But now I think it's pretty clear that they know that inflation is pretty much embedded in the U.S. economy and perhaps the global economy, that the Fed leads that effort if they're going to bring it down, and they are determined to do so. And I think the entire FOMC is on board with that, and so the markets are accepting that. I think it's going to have an impact on the market for a while yet as they absorb these rate increases, the one that we just had are today, and more to come through the end of the year and probably beyond that.
Right, and 4.6% target in terms of that funds rate forecast. Any idea of the pace that we could see certainly tightening to get to that? And could we see perhaps a fourth consecutive 75 basis point cut in November? And I'd like to add to that, away from inflation, what other metrics could certainly factor in to that path of rate hiking?
Well, I think they're going to, when they see the next inflation numbers in the middle of October, that will have a big part. If those numbers stay high, I think the odds on another 75 basis point increase are pretty strong. If they were very modest, I think the Fed probably still do another 75 to make sure that they get above 4%, but there would be a little more question around that. And then certainly in December, it might ease off. But I think the whole point of the FOMC now is they know they're going to get closer to 4.5% this year. And then they're going to, as they go along that line, they're going to watch the inflation numbers and they're going to watch the unemployment numbers. That'll be part of the calculus for them as they go forward from here in terms of how fast they go and how high they go in the end. And remember, finally, that it's not talked about much, but the Fed is in quantitative tightening. They're reducing their balance sheet by $95 billion a month. And that will take some liquidity out of the market and will be somewhat disruptive to the financial markets. And that could actually add to the uncertainty around the economy and the likelihood of a recession. And with that recession, I think then you would see inflation start to fall a little more systematically going forward.